Imagine waking up one morning and discovering that a decade of your hard-earned savings has been slashed in half. The headlines scream about the market crash, but for most people, it's too late. You see, man, history has a way of repeating itself. And right now, we are standing on the edge of what could be the greatest financial bubble in history. From tech stocks soaring to housing markets inflating, everything seems unstoppable. But underneath the glittering gains lies a dangerous truth. Most investors are ignoring the warning signs. People are borrowing more, taking excessive risks, investment, and chasing returns without understanding the fragility of the system. The economy might feel strong and your portfolio may look impressive, but bubbles don't announce themselves before they burst. If you don't know how to protect your money, you could lose a fortune. Today, we're going to break down exactly how this bubble works, why it's different from anything we've seen before, and most importantly, what strategies you can use to shield your wealth before it's too late. ChatGPT said a market bubble is one of those financial phenomena that can seem abstract until it hits your own wallet. And by then, the damage is often irreversible. At its simplest, a bubble happens when the price of an asset inflates far beyond its intrinsic value, creating a fragile and unsustainable financial environment. What makes bubbles particularly dangerous is that they rarely follow a linear or predictable pattern. Instead, they start subtly, almost imperceptibly, often fueled by optimism and the belief that this time is different. Investors see certain assets, whether tech stocks, real estate, or cryptocurrencies, gaining value rapidly. The fear of missing out takes over investment, and more people jump in, not because they understand the fundamentals of the investment, but because they see others profiting and don't want to be left behind. This is where speculation begins to override reason, and the first seeds of a bubble are planted. Initially, asset growth may appear entirely rational. Companies are launching new products, markets are expanding, and everyone seems to be making money. But the key factor that distinguishes a bubble from genuine market growth is the widening gap between asset prices and their actual value. In a healthy market, prices are generally tied to measurable factors: earnings, cash flow, dividends, or tangible value. In a bubble, those fundamentals no longer drive pricing decisions. Instead, investor behavior, media hype, and psychological factors dominate. People start buying not because they see long-term value, but because they expect someone else will pay more for it later. This self-reinforcing cycle of buying and price inflation can go on for months or even years, giving the illusion that the market is invincible. Leverage plays a critical role in inflating bubbles. When investors borrow money to buy assets, the stakes rise dramatically. Borrowing amplifies returns during the upswing, encouraging even more investment, but also magnifies losses when the market turns. This combination of optimism, speculation, and leverage creates an environment where asset prices become highly volatile and vulnerable to a sudden collapse. Even minor shifts in confidence, such as a disappointing earnings report, geopolitical tension, investment, or a change in interest rates, can trigger a rapid and severe correction. What seemed like unstoppable growth quickly turns into panic as everyone rushes to sell simultaneously, driving prices down at an alarming rate. History offers countless examples of how bubbles develop and collapse. Consider the dot-com bubble of the late 1990s. Investors poured money into internet startups without evaluating whether these companies had viable business models or sustainable revenue streams. Stock prices soared, driven almost entirely by hype and the fear of missing out until reality caught up. When profits failed to materialize, the market crashed, wiping out trillions of dollars in wealth and leaving countless investors financially devastated. Similarly, the housing bubble of the mid-2000s was fueled by easy credit, speculation, and the belief that home prices would continue to rise indefinitely. Mortgages were approved for buyers who had no realistic means of repaying them, and the eventual collapse triggered a global financial crisis. Even as far back as the 1600s, tulip mania in the Netherlands showed the same patterns: a speculative frenzy driving prices far beyond intrinsic value, ending in sudden collapse. Understanding the mechanics of a bubble is crucial because it reveals why traditional investment strategies can fail during these periods. Relying on past performance or assuming that high growth will continue indefinitely can be disastrous. Bubbles are fundamentally about psychology and human behavior. Fear, greed, and herd mentality more than about economics or logic. Recognizing the signs early, such as rapid price increases disconnected from real value, widespread speculation, and heavy reliance on leverage investment, allows investors to make informed decisions. Without this understanding, it's easy to be swept up in the excitement, believing the hype only to face devastating consequences when the bubble bursts. Ultimately, investment, the mechanics of a bubble are a cautionary tale. Growth can be intoxicating, but ignoring fundamentals and succumbing to speculation is a risk that history has repeatedly shown can destroy wealth in the blink of an eye. ChatGPT said, recognizing the warning signs of a market bubble is one of the most important skills an investor can develop. Bubbles rarely announce themselves with flashing lights or alarms. Instead, they grow slowly, fueled by optimism, greed, and the fear of missing out. By the time most people realize a bubble exists, prices have already skyrocketed, and the risk of a sudden crash is high. Understanding these signs early is crucial because it gives you time to adjust your strategy, protect your money, and even position yourself to take advantage of opportunities that emerge once the market corrects itself. One of the most telling indicators of a bubble is irrational investor behavior. When people start buying assets without fully understanding what they are purchasing, relying solely on trends, or borrowing excessive amounts of money to invest, it's a strong signal that the market is overheated. This behavior is often driven by the belief that prices will continue to rise indefinitely, a dangerous assumption because markets are cyclical by nature. Another key warning sign is economic imbalance. Bubbles almost always occur in environments where debt levels are rising faster than income, spending exceeds realistic economic growth, and asset prices climb far above historical norms. For example, during the housing bubble of the mid-2000s, home prices increased at a rate far higher than wage growth investment, fueled by easy credit and speculative purchases. When interest rates rose and people could no longer afford their mortgages, the bubble collapsed, resulting in widespread foreclosures and a financial crisis. Investment. These imbalances often indicate that the market is operating on borrowed confidence rather than genuine economic strength. Paying attention to metrics like household debt, corporate leverage, and inflation rates can provide critical insight into whether asset prices are being supported by fundamentals or simply speculation. Media hype and social sentiment are equally powerful indicators of investment. In today's digital age, news, social media, and financial influencers can amplify market trends at an unprecedented speed. When everyone around you is talking about a specific investment, praising its potential, investment, sharing, get rich quick stories, emotions begin to outweigh rational analysis. People start investing based on fear of missing out rather than careful evaluation of value. A classic example is the cryptocurrency surge of late 2017. Bitcoin and other digital currencies experienced meteoric gains, not necessarily because of underlying utility or adoption, but because of widespread media attention and speculative frenzy. Investors ignored warnings, believing the price would only go up, and when confidence faltered, the market dropped dramatically, leaving many with substantial losses. Observing sentiment trends and separating hype from reality is essential for avoiding similar pitfalls. Another subtle yet critical sign is the rate at which prices are increasing. Rapid, unsustainable growth is almost always a red flag. In a healthy market, asset prices grow steadily, reflecting actual improvements in earnings, revenue, or productivity. During a bubble, prices often rise at an exponential pace, detached from underlying value. This is sometimes referred to as a parabolic rise, where prices double, triple, or even quadruple in a short period. While it can be tempting to ride the wave and chase quick profits, this pattern is typically unsustainable and precedes sharp corrections. The earlier you recognize these abnormal growth patterns, the better positioned you are to protect your wealth. Finally, external factors such as rising interest rates, regulatory changes, or shifts in economic policy can trigger the bursting of a bubble. Many investors overlook these risks, assuming that growth will continue regardless of external pressures. However, when leverage is high and prices are inflated, even minor policy changes can have catastrophic effects. This is why monitoring broader economic indicators alongside market behavior is critical. By combining observations of investor psychology, economic fundamentals, sentiment trends, and price behavior, you create a framework to detect bubbles before they collapse. In essence, identifying warning signs is about developing awareness, discipline, and skepticism. It requires looking beyond short-term gains, questioning the hype, and asking fundamental questions: are prices justified by real value? Are people investing with understanding or emotion? Is debt inflating the market? By paying attention to these indicators, you gain the foresight to take protective measures, avoid financial ruin, and make rational decisions when others panic. Learning to spot these warning signs is not just about survival, it's about empowerment, giving you control over your financial future in the face of inevitable market volatility. When a market is inflating into a bubble, investment, protecting your money becomes less about chasing returns and more about preserving wealth. Many investors make the mistake of assuming that high growth will continue indefinitely, but history has proven time and again that bubbles end abruptly, often wiping out significant portions of portfolios in a matter of weeks or months. The first step in protecting your money during such periods is diversification. By spreading investments across different asset classes, stocks, bonds, real estate, investment, even commodities, you reduce exposure to any single market that may collapse. Diversification doesn't guarantee profits, but it mitigates the risk of catastrophic losses. For example, someone heavily invested in tech stocks during the dot-com bubble experienced devastating losses, while those who also held bonds or cash had a cushion that softened the blow. The principle is simple. Don't put all your eggs in one basket, especially when the basket is teetering on a fragile market peak. Another critical strategy is avoiding leverage or speculative bets. Borrowing money to invest amplifies gains during periods of growth, but it equally amplifies losses when markets turn. Many investors during the housing bubble of 2008 were encouraged to take on massive mortgages to rent, believing home prices would continue rising. When the market corrected, not only did the value of their assets plummet, but they also remained obligated to pay back the borrowed money, leading to financial devastation. Maintaining a conservative approach during bubble conditions ensures you don't expose yourself to risks that can wipe out years of hard-earned savings. Everything makes a good investment. Opting for investments that you fully understand and that don't require excessive borrowing is a defensive move that allows you to weather volatility without panic. Allocating a portion of your portfolio to assets with intrinsic value is another crucial method of protection. Cash, government bonds, or tangible investments like precious metals are less vulnerable to speculative swings than highly hyped stocks or cryptocurrencies. These assets act as a stabilizer, giving you liquidity to act when opportunities arise or losses occur elsewhere. For instance, during the 2008 financial crisis, investors who had significant portions of their wealth in cash or gold were able to buy high-quality assets at discounted prices, while others were forced to sell at a loss. Think of this strategy as building a safety net. You may not earn spectacular returns, but you maintain the ability to survive and thrive when the bubble inevitably bursts. Hedging strategies can also be an effective way to protect money during bubble conditions. Tools like options, inverse ETFs, or other financial instruments allow investors to offset potential losses in overvalued markets. While these strategies require careful understanding and planning, they provide a form of insurance that can reduce the impact of sudden downturns. Investment hedging isn't about predicting the exact timing of a market collapse. It's about managing risk so that a portfolio remains resilient in uncertain conditions. Even partial protection through hedging can prevent emotional panic selling, which is often one of the biggest contributors to losses during crashes. Beyond investments, personal financial preparedness plays a crucial role. Maintaining an emergency fund ensures that you won't be forced to liquidate assets during a market downturn. Life doesn't stop during financial crises, and having cash reserves allows you to meet living expenses without tapping into volatile investments. It also gives you the freedom to make rational, strategic decisions rather than reactive ones driven by fear. Emotional discipline is a powerful yet often overlooked tool in protecting your money. Markets are unpredictable, but panic and impulsive decisions are entirely avoidable if you prepare in advance. Finally, investment. Protecting your money during a bubble is not just about avoiding losses. It's about positioning yourself for future gains. When the bubble bursts, fear drives many investors to sell at rock bottom prices, creating opportunities for those who remain calm, informed, and liquid. By focusing on preservation, diversification, and risk management, you ensure that when the market corrects itself, you have the resources and stability to make wise decisions rather than being forced into reactive, costly mistakes. In essence, preparing for a market bubble transforms a potentially disastrous scenario into an opportunity to build long-term wealth. By understanding the risks, avoiding leverage, diversifying, and maintaining emotional discipline, You shield yourself from the worst effects of a crash while maintaining the ability to capitalize on the market's recovery. This approach separates successful investors from those who suffer catastrophic losses, proving that preparation, not speculation, is the key to surviving and thriving in volatile markets. ChatGPT said, history offers investors more than just stories of loss. It provides a roadmap for how to navigate the financial markets with wisdom and discipline. Every major bubble, from the Dutch tulip mania of the 1600s to the 2008 housing crisis, follows a similar pattern: excessive optimism, easy access to credit, inflated asset prices, and a collective belief that prices will rise indefinitely. And understanding these patterns is critical because it allows you to separate emotion from logic, make informed decisions, and ultimately protect and grow your wealth. The lesson from every bubble is the same: investment. Human behavior drives markets as much, if not more, than economic fundamentals. Fear, greed, and herd mentality often outweigh rational thinking, creating environments where asset prices can soar far beyond their intrinsic value and then collapse with astonishing speed. By studying history, you can recognize these behavioral patterns before they turn into financial disasters. One of the clearest examples comes from the dot-com bubble of the late 1990s. Investors poured money into internet startups, often without examining whether these companies had real revenue or sustainable business models. Stock prices climbed exponentially, detached from tangible fundamentals, fueled largely by hype and the fear of missing out. When the bubble burst, trillions of dollars in market value vanished almost overnight. Those who studied prior bubbles, paid attention to valuations, and maintained disciplined investing strategies were able to avoid catastrophic losses. The lesson is that while markets can appear unstoppable during periods of exuberance, they are always subject to correction. And those prepared with knowledge and foresight can survive and even thrive when the correction comes. Learning from history also emphasizes the importance of long-term thinking. Investment. Many investors focus solely on short-term gains, buying into trends because everyone else is doing so. While it can be tempting to ride the wave, history repeatedly shows that short-term thinking often leads to losses when bubbles burst. Successful investors focus on underlying value, fundamentals, and strategic allocation rather than chasing speculative profits. They diversify their portfolios to minimize risk and allocate resources to assets that have intrinsic worth, such as cash, bonds, or physical assets. This disciplined approach ensures that investment, even in periods of extreme market volatility, their wealth remains protected. Investment. Historical patterns show that those who prioritize preservation over speculation are best positioned to capitalize on opportunities when markets normalize. Emotional discipline is another critical lesson. Bubbles are fueled by human emotion, and understanding this allows you to step back and evaluate reality rationally. For example, during the 2008 housing bubble, investment. Widespread media coverage and financial institution messaging suggested that housing prices would continue rising indefinitely. Many people ignored warning signs because they were swept up in collective optimism. Investment. Those who approached the market with skepticism, questioned assumptions, and avoided speculative leverage were able to protect their wealth and avoid panic-driven losses. Emotional intelligence. Resisting the urge to follow the crowd blindly is just as important as financial acumen when navigating a bubble. Another aspect that history highlights is the importance of preparation for volatility. Markets will inevitably experience periods of irrational growth and contraction. By maintaining liquidity, avoiding excessive debt, and preparing defensive strategies, you ensure that you are not forced into reactive decisions that often result in financial loss. An emergency fund, diversification, and investment in assets with intrinsic value provide a safety net that allows you to remain calm and rational even when markets fluctuate wildly. Investment. The goal is not to predict the exact timing of a crash. That is nearly impossible. But to be ready so that when the market corrects itself, you can respond strategically rather than reactively. Finally, learning from history is not just about avoiding mistakes, it's about creating opportunities. When bubbles burst, fear dominates, and many investors sell at the bottom, creating undervalued assets. Investment. Those who have preserved capital, maintained discipline, and studied historical patterns can invest during these periods at advantageous prices. By applying lessons from past financial crises, you position yourself to not only survive, but also to thrive in the aftermath of market corrections. In essence, history teaches that wealth is preserved and built through knowledge, preparation, emotional discipline, and long-term strategic thinking. By internalizing these lessons, you gain the insight and confidence to navigate any market environment, protect your money, and capitalize on opportunities that emerge when others panic.